One aspect of blockchain that is gaining widespread adoption among the early adopters is decentralized finance, also known as DeFi. So in this video, we are going to look at what exactly DeFi is, how it works, and why do we even need a decentralized financial system. And because finances and money is so integrally tied up to all our personal lives, including you and me, we'll see how decentralized finance has potential to change our futures. Let's start by defining what decentralized finance or DeFi stands for. So decentralized finance is a system of open, permissionless, and interlocking financial products that focus on borrowing, lending, and other banking services. Now, some people say that this is the beginning of a new financial system that is completely open, permissionless, and most importantly, internet native. So I guess the question is this a programmable money that is being realized right now? Well, let's find out. Now, as you may have already seen from other videos, I don't generally stop at a definition. I generally like to dissect everything and look at it from a critical manner. And we'll do the same thing with this DeFi as well. To begin with, we have to understand our current financial systems. So we have a money supply, and this can be a US dollar, Great Britain pounds, or euros. And this money supply is actually controlled by a very small group of central banks who then work with even smaller group of corporate banks to control the world economies, or in other terms, has helped to keep the world running. Now, this system worked very well for a good part of the last century and has managed to keep the lights on for many of the world economies. But as you may have guessed, there are various limitations in this system, because if there weren't any limitations, then we wouldn't have experienced the financial crisis or the Great Recession. Approximately 1.7 billion people don't have access to these financial systems because they're not part of this network. And there are many reasons for this. Most likely, no permanent address or no credit history, and in some cases, no banking infrastructure at all. We've already seen some aspects of centralized finances so far, but let's look at its architecture to understand it even better. So this architecture looks like a hub and spoke that you might come across in a wheel of a bicycle or a push bike. So there are centralized hubs like New York and London, which are the operational hubs for financial services. Now, these operational hubs connect to regional banks or regional corporate offices that have their own local regulations. Now, this system of hub and spoke has worked really well and is really important to maintain the global economic balance. The financial crisis and the Great Recession actually revealed a flaw in this architecture, where a few big institutions had problems on the balance sheet, which led to a domino effect of tumbling economies, which eventually led to the global recession. So you must be wondering, there must be a solution for this, right? And yes, this is exactly what decentralized finance is trying to solve by lowering the barriers for those who did not have access to banking and borrowing. So what is DeFi? Well, decentralized finances uses technology to disintermediate centralized models. And with blockchain and smart contracts, which is basically agreements, we can build financial services that can be fully decentralized, meaning there is no single central institution controlling everything. And sometimes the transactions can be fully automated and can be made autonomous. This enables financial services for anyone, anywhere, regardless of age, ethnicity, and cultural identity. Also, DeFi applications enables users to have more control over their money through personal wallets and trading services that cater to individuals rather than institutions. Let's look at how DeFi actually works. And like any other financial system, there are a few requirements. First of which is a stable currency, because for any financial transaction, stable currency is very necessary. And US dollar and euro, like any other fiat currency, are relatively stable, which means that users or people who own these don't lose purchasing power overnight. So let's take an example here. Imagine you have a business and you quote your client $5,000 for a service that you're providing, and the client has 2 months to pay you back. At the end of 2 months, when the client does pay you back $5,000, you know exactly what kind of goods and services you can purchase for that $5,000 elsewhere. But this sort of certainty is not possible with crypto assets because of its volatility. And we need a solution here where a crypto asset is very stable. Also, having stable currencies is very important for services like lending and borrowing. One solution here is actually stable coins on blockchain, and the blockchain offers two approaches for this. There's one-to-one US-backed assets where the coins are created and pegged against US dollar or some real-world asset, and these kind of coins are relatively easy to design and produce. But this also means that we have to depend on a separate company, which means we rely on their reputation and legal enforcement now, which also means that the financial products are linked to an entity outside of the blockchain, which is not really desirable. And the other approach is actually algorithmically standardized assets, where there are no central parties and there are no links to entities outside of the blockchain. Now, there are various algorithms for standardization, but one popular one is collateralized debt model, which was pioneered by MakerDAO and its DAI stablecoins. So now that we have a solution for a stable coin, we can look at the next requirement for a financial system, which is liquidity. And this is foundational to any DeFi ecosystem. And in DeFi, we have something called as liquidity pool, which is basically funds thrown together or collected from various users into a big digital pile. So an example here would be you, me, and 10 other people have contributed our crypto assets into a big liquidity pool that we can use to build more financial services or financial product. And as of 2020 December, there's approximately 15 billion being collected into liquidity pool by liquidity providers in the DeFi protocol. So let's look at some example financial products built on top of this DeFi ecosystem. First of all, there is automated market maker, also known as decentralized exchanges. These exchanges are very similar to a stock exchange, but there are no central institution or parties controlling them. Now, a user can participate in this automated market maker in two ways. The first is the obvious one, where a user wants to exchange crypto assets with some other crypto assets. And the second one is when a user wants to deposit or contribute to the liquidity pool. And in exchange for this contribution into the fund, the user earns a trading fees on any trading that happens within that pool. A very good protocol here is Uniswap protocol, which is a decentralized exchange. So here, if you want to buy another coin, you directly go and buy from the liquidity pool and don't have to wait for a seller on the other side to sell you those crypto assets. Now, the next financial product within the DeFi ecosystem is actually DeFi lending. And this lending protocol is basically a platform that links borrowers and lenders in a decentralized manner. Again, here we have two participants. There are the borrowers and the lenders, and the platform allows borrowers to borrow crypto assets and lenders can deposit their crypto assets into an identity pool and can basically earn interest. And this interest is what the borrower is actually paying back. A popular protocol here is Compound Finance Protocol, and you can check out their websites for the latest interest rates on borrowing and lending. Now, you could ask me, is this basically peer-to-peer lending? Well, actually no, because lending protocol operates with the identity pool. What this means is a lender does not have to wait for the counterparty borrower to be there to participate in this financial product. And the supply and demand is actually managed through various incentives. One example here is if the demand for borrowing is quite low, then this is usually reflected in the lending interest rates. When we usually talk about borrowing loan, there is this concept of collateral. Similar to a bank loan, where a borrower has to put up a collateral to gain access to that loan, and in case the borrower fails to pay back the debt, the bank can sell off the collateral to pay the loan. Similarly, in DeFi ecosystem, the borrower wanting to borrow from the lending protocol has to put up a collateral, and this is usually a crypto asset. So let's take a quick example of this lending protocol. So imagine a scenario where Let's say I have 100 BAT tokens, basic attention token, and I think that the value of these BAT tokens will go up and I want to hold on to this. But I also think that the REP token value is going to go up in the future, and I would like to own a few of these REP tokens. But I don't want to sell off my BAT tokens, and let's imagine I don't have any extra money lying around. So in this case, I can use my BAT tokens as collateral with the lending protocol and get some loan. And with this loan, I can buy some REP tokens. Now after this, there might be two scenarios. The first is the REP tokens value really go up and I'm able to sell off these REP tokens, and then I can pay off my debt and I can keep the profits. And on the other hand, the REP token value might really go down and I'm not able to pay off my debt, in which case the lending protocol can sell off my BAT tokens to pay my debts. One concept to keep in mind here is, when I put up a collateral, I might not be able to use the 100% of the value of my collateral. An example, if I have $100 worth of BAT tokens which I put up as a collateral, from the lending protocol, I might not be able to use that $100 to buy my next crypto asset. It might be around $75 that I could use to buy my other crypto asset. This is because of volatility within the prices of crypto assets. This allows lending protocol to manage its risk exposure very well. And this system is called as loan to collateral ratio. So I hope you've learned something about DeFi and decentralized finances from this video. And if you did, like this video and leave your thoughts in the comments section. And on this channel, I'm dedicated to making videos that help us understand the world around us and how the world operates. And if that is something that interests you, then please do subscribe to this channel, and I'll see you in the next video.